Hey everyone, welcome back to Mortgage Market Minute. I'm Chen with Simple Mortgage, and every Thursday I break down what's happening in the mortgage and housing markets in plain language. Here's what we're covering today. Purchase applications rose despite higher rates. The 30-year fix hit its highest level in over a year. Consumer spending held up while the job market sent mixed signals, and the National Housing Index cooled for a second straight month. Let's start with applications. For the week ending July 17th, the seasonally adjusted purchase index jumped 6%, even as the average 30-year conforming rate climbed to 6.69%, its highest since last August. Growing inventory in many markets is helping keep buyers moving. Overall, the market composite index rose 1.9% seasonally adjusted. Refinancing dipped 2% for the week, but is still 7% above a year ago. The refinance share slipped to 41.2%, while ARMs ticked up to 7.7% of applications. FHA and BA shares both edged down slightly, while USDA held flat at 0.5%. That mix shift suggests some buyers are exploring different loan structures to manage today's affordability. A reminder, there's more than one path into a home. Now rates. The daily 30-year fixed index rose to 6.85% today, the highest since June 23rd of last year. But here's the context. Even here, rates remain in the lower half of the range we've seen since late 2022. A quick snapshot. 15-year fixed sits at 6.29%, FHA at 6.40%, Jumbo at 6.92%, the 7/6 adjustable rate mortgage held steady at 6.55% and VA at 6.42%. The 10-year Treasury yield is at 4.699%. Zooming out, rates fell from 6.75% last July to 5.99% by late February, our best run since 2022. War-related fuel swings and stronger economic data pushed them back to 6.75% by May 19th and were a bit higher than that today. Drivers include rising oil prices, lingering inflation concerns, and earnings season bond selling. Being the highest in a year says as much about how good the past year was as it does about today's level. On the economy, retail sales rose 0.2% in June and 0.7% excluding gasoline, a sign consumer activity remains resilient even as gas prices swing. The labor market is mixed. New unemployment claims sit around 208,000. Relatively low, though some job losses may not be fully captured. Continuing claims remain elevated at 1.81 million, meaning some job seekers need more time to find work. These data points feed directly into the broader picture shaping mortgage rates, and stable income and employment are always factors underwriters weigh during the loan process. Turning to housing, the MBS Highway National Housing Index fell for a second straight month, dropping 6 points to 32 after a seasonal high of 47 in May. It's still 6 points above where it stood a year ago. Nationally, just 16% of respondents called buyer activity active, down from 22% in June and 32% in May. Buyers remain highly sensitive to rate moves. Regionally, the West and Midwest saw the steepest buyer activity declines, while the Northeast was the only region still in expansion, climbing to 59. The Mid-Atlantic, Northeast, and Midwest all stayed at or above the 50 expansion mark on price direction. This month's survey also asked about rate lock-in. 47% say it's still strong, down from 53% a year ago. Life events, marriage, a growing family, a new job continue to prompt some homeowners to move anyway. To sum up, buyers are still active despite higher rates. Rates themselves remain historically mid-range even at a one-year high, and the housing market is cooling but not collapsing. If you'd like to talk through your own situation, please contact us. Follow us on Facebook, Instagram, YouTube, X, and LinkedIn, and drop your questions in the comments. Quick disclaimer, this content is for informational and educational purposes only and isn't financial, legal, tax, or mortgage advice. Rates and programs are subject to change, and all loans are subject to credit, income, asset, and property review. Thanks for watching, and I'll see you next Thursday for another Mortgage Market Minute.